guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is a real estate investment expert and repeat guest, Greg Dickerson. Now, Greg is a serial entrepreneur, real estate developer, and coach and mentor. He has bought and developed and sold over $250 million in real estate, built and renovated hundreds of custom homes and commercial buildings, developed residential and mixed-use subdivisions, and has started 12 different companies from the ground up. Greg currently coaches and mentors some of the top entrepreneurs, real estate investors, and real estate developers around the world, helping them start, grow, and scale their business, raise more capital, and do bigger deals. Greg currently has clients with over $2 billion in AUM. In addition to that, Greg also served in the United States Navy right out of high school and has always been a leader in the community, as well as supporting, advising, and serving on the boards of several churches, ministries, and nonprofit organizations. And guys, if you want to go back and reference, it's going to be a pretty interesting comparison, because the last time we had Greg on, we were on episode 233, and that was right before COVID hit. And so it's going to be interesting to compare pre-COVID conversation to post-COVID conversation. So again, episode 233, if you want to listen to the last show I had Greg on. And so with that, guys, I want to welcome back Greg Dickerson. Greg, how you doing, my friend?
Doing great, Kevin. Thanks for having me.
Yeah, excited to have you back here. Excited to catch up with you in this post-COVID world that we find ourselves in. Again, two years. I can't believe that it went from 2 weeks to 2 years, but here we are. We're back at it, and we're still here. We're still talking real estate, right? So that's the important thing.
Yeah, that was June. Well, the episode was released June 11th of 2019. So yeah, it's been a while.
So let's, for those that might not have ever listened to that show, Greg, they don't know who you are. Take a few minutes. Tell us a little bit more about your background. I gave you that brief introduction, but please expand upon it if you would, and give us some insight as to, again, who you are and how you found yourself into real estate.
Yeah. So, we went in depth on that episode, but, bottom line was, I was a natural born entrepreneur, starting as a kid, cutting grass, raking leaves, doing all that. Always wanted to be an entrepreneur. Went in the Navy right out of high school. So I did not go to college, and I did retail in the Navy. So I got some good business training there. And when I got out of the Navy, I did two things: restaurants and construction. So, I worked in restaurants and I always had a side business in construction, on the side. And I got into management in restaurants, and I got some really good business training there. 1997, I moved to the Outer Banks of North Carolina. That's Kitty Hawk, Kill Devil Hills, where the Wright brothers first took off, where flight originated. It's a resort summer vacation destination. It's always been a short-term rental community, pretty much, very small year-round population. Year-round population is probably 30,000 to 40,000. And, in the summer, it grows to 800,000 people a week go through that area. So it's incredible. But so I started my career down there. I moved there to open restaurants, but I got into construction instead. Started a little remodeling handyman company. My first year there, 1997, I did about 250,000 in sales. I built that into a $30 million building company in 7 years, one of the largest builder developers there. Sold it. I started 12 other companies along the way at the same time in that 7-year period, built them up, sold them off, and learned how to become a real estate developer. So, started out as a remodeling handyman contractor, started building spec houses, started doing developments, got into commercial, doing land developments, and then just kind of grew and scaled from there. Started and grew and scaled a bunch of companies, exited them, and reinvested all the profits back into the projects and deals I was doing. So that 250 million, that was my own cash, my own capital. I didn't have any investors primarily. That was all my own momentum. And then I did, several $100 million worth of deals with investor capital and other joint ventures and businesses and companies and things like that along the way. But that primarily core was just me, doing my own thing, reinvesting cash and growing and scaling, my own companies. And so that's me in a nutshell. I'm just a serial entrepreneur. I love to build people. I love to build companies. I love to build buildings, repurpose buildings, and just do, really fun, creative things. What I'm really good at is, from a real estate development standpoint, is the creativity of maximizing a property. That's kind of a gifting and a skill set that I had, where I was able to, maximize a lot of properties that other people weren't able to do anything with, or do more with them that other people didn't see or realize. And then from a business standpoint, I'm a people builder. I'm really good at identifying top talent, recruiting, hiring, training top talent, and then more importantly, turning them loose and letting them do their thing and building companies with me and for me over the years. So, those are the things that, I'm really good at, and it's kind of what I do now. I coach, mentor, and do things through others and leverage the talents and abilities of others.
Yeah. Well, fantastic. I appreciate you sharing that with us, Greg. And what I love to start this conversation with is, again, last time we talked was June of 2019, again, pre-COVID world. You had a number of hospitality projects that you've been working on, as well as a few other things. Give us the comparison as to what the world looks like today for what types of projects you're working on, and ultimately, what transpired from 2019 to present time.
Yeah, so we had about $120 million worth of hotel projects, ground up, mid-scale type hotels, Marriott, IHG product, and had 4 sites in Virginia that we were looking at. And there were a lot of units, coming online all of a sudden during that time period, pre-pandemic. And our construction costs were coming in just through the roof. So, the numbers just didn't make any sense. And I had tied up these sites with no money, zero money out of my pocket. So that's one of the things I teach people how to do, is how to tie up property without using any money at all, not even other people's, just no money, so that you can do the feasibility and everything. And we'd worked on them for about 6 months, and the numbers were coming in, and it just wasn't adding up. So I decided to table those, and lo and behold, 6 months later, bam, the world almost comes to an end. Well, I guess it might have been about eight or 9 months later. I guess that was June to March of 2020, June 2019, March 2020. So 8-9 months later, but very fortunate that I decided to table those, because we'd been coming out of the ground with those and coming online, right at the end of the pandemic, in 2021, with our estimated, completion dates and opening of those. So that was really interesting. And, there were a lot of new projects in the pipeline, and a lot of them kept going and came online during the pandemic. And then, of course, we saw what happened to the hotel industry. It's just been decimated. It still hasn't recovered. There's still a lot of distress in that market. You haven't seen a lot of assets coming on market at scale, because a lot of that stuff's done behind closed doors, where lenders don't want that kind of bad debt on their books. So a lot of that stuff gets worked out behind the scenes and under the table. So there just hasn't been a flood of those assets hitting the market. There are some out there, but what's really interesting now is a lot of the hotels are getting repurposed into other assets like multifamily or office buildings and things like that. So the other thing that we saw was the Airbnb market explode. Mm-hmm. So with international travel being shut down, and with the pandemic and the remote work and things like that, people started going to these resort areas like the Outer Banks, mountain areas, other areas, and taking up Airbnb. So the Airbnb VRBO short-term rental industry has really exploded, which is interesting, because that's where I cut my teeth, in the business back in the day, 25 years ago. And, that industry's changed and evolved. But I think what we're going to see now is even more pressure on the hotel industry in the country, in the United States, because, international travel is opening up again and restrictions are being lifted everywhere. So people are itching to get out of this country and go back and travel abroad. So I think you're going to see a little pressure on, the Airbnb industry in the United States this summer, as well as the resort, the hotel industry, this year in the summer. But a lot of the popular resort areas are still doing well. They still have a lot of bookings, and I haven't heard, of any pressure on those areas yet. But yeah, very interesting times.
Yeah, no, I appreciate you providing that for us. And I want to back up a little bit and talk about the hotel developments that you ultimately pulled out of, again, as we ran up to COVID times. What are your thoughts on, I guess the first question, let me back up. The first question would be, were those hotels, would they have been built to service, for the most part, business travelers? Is that the predominant clientele is going to be?
Yeah, I mean, one of them was in a college market, so it would have been a mixture of business and then college town kind of, travel. There was another one that would have been a lot of business travel, but it had a sports complex nearby. So some of that, like a youth sports complex where they do tournaments and things like that. So primarily a little bit of business and a little bit of leisure. So that was the real key. One of them was in a market where there was a major hospital, regional hospital, that would have had a lot of travel for surgeries and hospital staff and meetings and things like that. So we looked at different demand drivers. Obviously, when you're doing a hotel, you got what's your demand driver. Yeah. So we had locations that had a number of demand drivers between leisure and business.
You'd mentioned a strategy of how you tie up land with no money at all, not other people's money, just no money at all. Would you mind elaborating on that strategy? Give us a golden nugget here that we can all take home with us.
Yeah. So you never, ever, ever, real estate 101, right? Real estate development 101. You never buy a piece of land until you get all of your entitlements fully permitted, ready to go. Now, there are certain markets where there's a ton of competition. If you feel like you absolutely have to have that parcel, and the only way you're going to get it is to close, well, that's your decision. You just need to make sure that you can withstand the worst case scenario if you don't get the zoning you're looking for, if you get downzoned. And downzone means the property might be approved or zoned for one thing, for 100 units or whatever. And then the city all of a sudden decides to change the zoning where you can only do 50 or 20. That's downzoning. So anyways, long story short, what I do is I get depending on the size and what I'm doing, a minimum of 60 to 90 days of a feasibility period where I get 60 to 90 days just to study the property to see if it's even going to work, if what I want to do is even feasible. And that's where I go in and I start, studying things like, for a hotel, you study ADRs, you try to get some construction costs, you try to understand utilities, traffic, things like that, demand drivers, do your star reports and just, do very minimal things to understand, is the project even going to work? Is the city going to approve it? Are they behind it? Are they against it? Whatever it is. For land development, when I do land development projects like subdivisions, same kind of thing. What kind of opposition am I going to face in the community? Things like that. So I get, depending on the size of the project, 60 to 90 days. If it's a big project, I might get 6 months. Right? It's a free look, no money. It's just a total feasibility.
You're putting up earnest money, though, correct? I mean, correct me if I'm wrong.
That's what I mean. No earnest money.
Really, no earnest money or anything. Okay.
Yeah.
Okay.
No, that's just a feasibility. And then once I decide, okay, yes, it looks like this will work, looks like I can sort of do what I want to do, the numbers are going to work, then I put earnest money down and go for another, period of time in the due diligence process of getting all of my entitlements and the entitlement process. So the feasibility is a free look, no money down, no earnest money. And the agreement is I'll give them whatever work product that I create during that time period, they can have it. So if I do any surveys, if I do any market reports, if I do any of those types of things, I'll give that to the seller, as consideration, in terms of option money, instead of writing a check. Cause I don't even know if it's going to work yet.
Yeah. How realistic is doing that you mentioned, if it's in a little bit more competitive market, how realistic is going into it for that feasibility period, thinking that you're not going to have to put any earnest money up, during that feasibility period?
I've done it with every deal I've ever done that way. Really? So okay. In very competitive
I'm not a developer, so maybe that's just that is the common practice.
Yeah, and I'm I have a track record and I'm known in my market, so
Gotcha.
It's just not even a question. People know that I perform and I'm going to fulfill. But you got to have a certain amount of time to be able to just figure out, is this thing even going to work? And depending on the property, if it's a small project and it's a relatively known quantity, then you might get 30 or 45 days where it's just a free look. And it's just, hey, I want to control this property so I can investigate it for, 45 to 60 days to make sure that I can do what I want to do. And then if it looks like I can, then I'll put down some earnest money.
Got it.
And, I don't close until I get all of my entitlements, all my permits and all of that. Mm-hmm. And, if I don't close and back out at that point, well, then they get their earnest money, then they get to keep all the work product and all that.
Okay. Got it. Yeah. I wasn't aware that during that feasibility period that there typically isn't any earnest money put up.
Most people do, because they just don't know that you don't have to, and I don't do it for any other reason than, it just keeps it more clean and uncomplicated. If I just say, look, we're not sure if this is going to work. I need to make sure it's going to work. I want to control the property before I go do any due diligence. And let's agree, we agree on a purchase price. We agree on the rest of the terms and, give me 60, 90 days, whatever it is, to figure out if it's going to work. And then I'll put up an earnest money deposit and go from there. And, that can be anywhere from 10 to 100 to $1 million, depending on what it is.
Yeah, fair enough. Well, we talked about pre-COVID. Let's talk about post-COVID world, and give us some insights as to exciting projects. Where you've been spending most of your time here over the past 12 months?
Yeah, mostly land deals, either land entitlements or full-on development, utilities, everything, flipping lots to builders and things like, not flipping, but selling lots to builders, things like that. And then I delivered some product right before the hotel. I'd finished out all my residential projects and sold all those, where I developed and built, through the vertical. And now I just focus on land because I'm just not really interested in building the vertical anymore, in terms of residential. And then I've cleared through all of that. So right now I'm just kind of watching the environment and looking for opportunities because, obviously we have a pivot from the Fed. We've got a new Fed, no more quantitative easing. Interest rates are on the rise. And I'm really watching interest rates to the housing market right now because, rates are 4.75 today for a 30-year mortgage. that's going to put a lot of pressure on the housing market. It's really interesting time. So I'm kind of waiting to see how some of this plays out. I'm looking for a shift in the housing market. We're already starting to see it in some areas. So I'm really kind of watching those areas right now to decide where I'm going to make my next move and just kind of see how this all plays out with the Fed, with inflation, the war, all these different things that we have going
Yeah.
on right now. It's a very interesting environment out there.
Now, you're up in the Carolinas as well as Virginia, and so when you say that you've seen a shift in a few different select markets, what type of shift are you seeing?
So with interest rates rising, that affects the affordability of the borrower, right? Which is going to affect values and prices. So values in commercial real estate, prices in residential. So we're starting to see more properties come on the market, sitting on the market longer, not getting multiple offers like they were. We're seeing some properties sell for less than asking versus the other way around.
Wow.
We're starting to see deals fall out. So like builders, especially, and for anybody listening, another gold nugget, if you've been waiting to buy a house, your time is coming. The ones that can drop prices the quickest and will drop first are going to be the home builders. So in areas where big subdivisions are being developed, a lot of those contracts are going to fall out because the borrower that thought they could get 2.5%, 3% when they contracted for the house, now they're looking at 4.5%, 5%. They can't qualify. So those deals are going to fall through. And the builders, the big builders, they can drop prices and just cut inventory, and they will as soon as that market shifts. So keep your eyes on the new subdivisions with home builders and watch for price reductions and houses coming back on the market. And that's where you'll see your shift. And that's kind of what we're seeing in some of the areas. Every area is different. Florida's still red hot, the Sun Belt, where everybody's moving to from the Northeast and the Midwest right now. But we're starting to see it in a lot of markets right now where those little subtle shifts are starting to happen because interest rates are going up so fast.
You'd mentioned some of the students that you're working with are doing repositioning opportunities, taking a hotel and converting it to a multifamily. Maybe speak to those projects. I feel like I've seen quite a number of those just my social media feeds over the last 12 to 18 months, and it seemed like that's a red hot conversion opportunity at this point in time. Maybe would you mind speaking to a few specific projects that you're working on?
Yeah. So I've got one group in Tennessee that's doing a 2-story, motor lodge hotel kind of conversion into apartments. And there's been a couple of them here in my market. Then there's another one that's a senior living facility being turned into rental product. And a couple of them are doing different models. Some are just doing straight up year-round rentals, turning them into studios or combining units and doing 1-bedrooms. And then one of my other clients is doing short-term rentals, but not like Airbnb, like 3 months, 6 months, like traveling nurses, executive rentals, that kind of thing, where he's turnkey furnishing them and doing short-term leases. And he's getting a yield of about 30% more than his year-round rental portfolio. So really interesting, different products there. And different markets like student housing markets, the micro units, the 1-bedrooms and studios are really popular. In some other areas, I've got some clients doing office building conversions, converting big office buildings into either mixed use or just straight up multifamily. So, there's a lot of those opportunities out there right now as well.
Now, not every hotel or every office building makes for a good conversion prospect. And so maybe give some key elements as to what one should look for or, stay away from when considering, let's just speak to a hotel converting into a multifamily. What are some of the initial identifiers as to whether or not it would or would not work?
Yeah, hotels are more difficult generally because, the room size, rooms are very small and, a little bit more difficult to kind of combine. So your traditional, like a Hilton or Marriott or something like that's not ideal. But generally, if you have an older building that might have been something else, maybe an apartment building or maybe an office building that was converted to a hotel, the construction type of that building is generally going to be more flexible. So if you have steel frame or wood frame construction versus concrete construction, a little bit more cost effective and easier to convert. And then of course the old 2-story, lodge style hotels, the old school hotels like a Motel 6 or a Holiday Inn or something like that, that have, exterior entries, those are real easy to convert. And I've seen a lot of those being done, the old 2-story style, turning those into 1-bedroom and studio type product, especially in resort areas and in student rental areas, and things like that. And then for affordable housing units. So those are really easy conversions.
What are you seeing on average cost to convert per unit? I mean, is there a rule of thumb?
No, I mean, it depends on the building and the structure and, how the utilities and the makeup and how you're going to do that. But, if you're coming in metering everything and redoing the units completely, I mean, you might spend 50,000
Mm-hmm.
to 100,000 a unit. If it's just cosmetic, you might be able to get away with 20, 30,000 a unit.
Yeah, fair enough. And so outside of, we talked about some of the land projects, you kind of wrapped all those up that you've been working on and working with a number of students on other projects, but it sounds like you're holding tight with cash, but are you investing your own personal capital into any other asset classes in real estate or anything outside of real estate at the present time?
So I'm not long term. So, I'm a developer. I
Mhm.
like to buy and sell. So, I'm opportunistic and I need a lot of margins. So, I'm not somebody that's going to do a skinny value add deal or something like that. I mean, I like to double my money, so minimum. So those deals, you have to be patient, and I'm patient. I don't have to do anything. I've done a ton of deals over my career. So I'm looking for the good ones, fewer, bigger deals, that make a lot of sense, that provide, very, very nice returns. So it really doesn't matter to me what it is. I'm just kind of waiting to see how things evolve right now, specifically in the last few months with the Fed
Yeah.
pivot, with inflation being where it is, with interest rates rising, and everything going on with the war and everything. It's just a very delicate time right now. And but I see opportunities every day. Some of them I pass along to the people I'm mentoring. Like I've got people in the value add space that are doing multifamily acquisitions. That's a different business model
Hmm.
that I'm doing, and things like that. I'm coaching people doing ground up development, things like that. So um, you know I'm 55 now, and very careful with what I do, and it needs to make a lot of sense, and be creative and something that really piques my interest. But I haven't seen anything lately that's really exciting.
Yeah, fair enough. And I'm not going to say your crystal ball, but I would like your opinion. You're following all the current affairs, both in the U.S. and abroad, and lots of different moving parts at the present time. What is your opinion as to what the next 6 to 12 months might bring, and ultimately how that impacts the real estate marketplace?
So, you've got four things right now that you're really dealing with from a headwinds, standpoint. So we've come off a huge bull market. Asset, we're at the peak. This is the top of the market. I called it back in November. I told everybody, look, we're at the peak in all assets, stocks, cryptos, real estate, business valuations, everything is maxed out. And it's because of the Fed liquidity that's been pumped into the market, and low interest rates, zero risk environment. One of the things I've been doing is, these bear markets, I've been trading some stocks in these bear markets because you've got a lot of volatility right now. And typically I make my moves at the bottoms, March 2020, and in and out as it's gone up. But right now there's a lot of opportunities there. But basically your biggest risk out there right now that you need to think about, when I say risk, I'm talking about preservation of capital.
Hmm.
So you need to understand, what am I facing? What's my downside? And can I withstand the hit to the downside when it happens? That's what risk management is. And you've got inflation risk. That's number one. That's really affecting. Uh, we are a consumer-driven economy. If you're in the rental business, if you have tenants, well, that inflation affects their ability to pay rent. It affects their ability to afford things. You have the Fed, policy risk. So the Fed is no longer pumping liquidity in the market. They're not buying mortgage-backed securities. They're not buying bonds. So that's going to create a credit tightening. So less money being lent out. They're raising the interest rate. So the cost of that borrowing is going to go up higher. So that's less that people can borrow to consume goods, which means that the economy should contract. And you have obviously the war going on out there, and we don't know what the effects and impacts of that.
Hmm.
If that turns into World War III, that could be a very big issue for the economy and things moving forward. So from a growth standpoint of stagflation, where you have high inflation and low growth, there's a lot of potential headwinds for potential recession, which could create some stagflation going down the road. So there's a very delicate balance right now in the economy with everything that's going on. Inflation's a bigger problem than what a lot of people think. The Fed came out, Powell yesterday, with the strongest language he's ever given, saying 50-point basis hike the next meeting, probably another 50 after that, to get the Fed funds rate closer to 3% by the end of the year, maybe 4 versus 2%. That's huge. That's
Yeah.
going to make a big difference in a lot of areas. So, those are the things that I'm watching from headwinds in the economy that are very different than where we just came from And where we just came from has been since 2008, 2009. So that's when QE started. That's when zero interest rate policy started. The last time rates were raised were 2018, and we saw the reflection of that. The economy almost came to a halt. So they had to reverse, policy. The difference now is we've got super high inflation. So if we get to the point to where we get a 2018, 2019 moment, the Fed can't reverse course because inflation is so out of control, it'll create even more problems. So not sure how this is going to look, but we're going to know in the next few months, what these things are going to look like. So I'm very careful because I'm expecting what we've already seen. We're seeing deflation in assets. We're seeing assets deflate. In other words, that liquidity is coming out of the markets. Now, once you deflate, then you got to reprice. What's fair value? So we're in that repricing stage, price discovery now. We've deflated. The markets at all levels of assets, all markets, crypto, stocks, real estate, companies, valuations of multiples of what you pay for a company have all delevered. Now we got to reprice. What's a fair multiple now for the earnings of a company? What's a fair multiple now for real estate, given the interest rate environment? What's a fair value in stocks for, forward earnings? So those are the types of things that we're looking at right now in price discovery in all assets. So we just don't know where that's going to land.
So what advice do you give your students? I mean, how does one make an educated decision given your perspective on a potential investment opportunity?
Yeah, so it depends on what it is. You, number one, understand the risk, accurately calculate that risk and be able to withstand the hit if it happens. If it's real estate, make sure you got multiple exits, right? So you don't want to go into a real estate deal where you've only got one business plan, you only have one exit. You need to stress test that thing. You need to assume whatever your going in cap rate is, it's going to be, way higher than what you think going out, because as rates go up, cap rates will go up, and your values will drop. Not necessarily, point for point, but generally, that's kind of how it works. The more expensive your debt is, the less valuable that property is, because it's an income multiple. So, you want to make sure that you can kind of hedge that. You want to make sure that you talk to your lenders, have them scrub your deal, have them stress test it with you to make sure that, you understand what your risk is moving forward, and that, you can withstand that shock if it happens. And, the biggest thing to understand is things just can't always go up exponentially forever. At some point, you reach a tipping point where things have to level off. You need to understand where we came from and why values are where they are. And then you need to also understand rents. So if your business model is all about raising rents, you're already seeing attrition in Florida. In other words, people are moving because rents are too high.
Absolutely.
So you're already starting to see that. So you can only push rents so high. So if your whole business model is, I have to be able to raise rents or this deal doesn't work, you need to really assess that market and really understand, can I really raise rents on this property? And if people decide to leave, where are they going to go? What does that look like? Is there competition, or do you kind of have them? And, and be very sensitive, very careful about that. If you're buying a business or a company, how does that look, in a zero or in a rising interest rate environment where consumers have less money to spend? So if you're going to buy a business based on its earnings, what will that look like if people can't get credit and aren't spending as much and the economy declines a little bit? So you just need to be able to weather that and make sure you've got reserves and you've got a plan in place, with multiple exits if you need to be able to get out of that.
It's interesting, talking to that rent ceiling, you use Florida as the example, where there's a lot of people already leaving Florida because they literally can't afford to live here. And I've been wondering when that was going to happen. Really, I started wondering that before COVID even hit, right? And the major markets here in Florida, Tampa, Orlando, especially Miami, Jacksonville, not so much 2 or 3 years ago. Now, yes. And then, speaking to Texas, Dallas, Houston, what have you. And I feel like, I feel like we're nearing that point in time where I feel there's going to be a significant exodus from all those markets I just mentioned, because again, the average working folks cannot afford to live in a apartment rental community. The rents are just too high, and so
especially with gas prices now and
it's
food costs. I mean, that's what a lot of the landlords don't understand is these people are getting hit from multiple fronts, and something has to give.
And it's interesting. Maybe they had a little bit more money to spend, on fuel because they weren't traveling to the office. But as we start pushing employees to get back into the office spaces, they're going to have to start commuting again. Now they need to budget for these increased, fuel prices, what have you. Can't afford as much in the rent now. I mean, it's just there's a perfect storm of brewing, and we can kind of visually see the different elements of that. We just don't know exactly what that storm looks like when it actually when the lightning strikes. So
yeah. So you just have to be sensitive to it, plan for it. And then, if you're in an acquisition mode, you need to, factor that into your acquisition. And, if you're if you have a portfolio, you need to understand what's going on and what kind of pressure your tenants are under and what they can withstand. And, what level that pressure kicks in. So, if you have properties that are renting $2,500,